I was talking about this all last year, not just late last year, but throughout the year on my podcast. I was warning that job cuts were coming in tech, and they're still coming. This is not even close to the end of the layoffs. We're still near the beginning of what's going to be massive reduction in the workforce of these companies. And of course, some of the companies are going to see 100% reduction in their workforce because they're going to end up going out of business. And all of this is going to add to the problems for the economy, but also it's indicative of problems for these companies. Now, the initial reaction to the job cuts may be a boost in the stock price because the immediate effect is lower costs and so higher profits. But the reason these companies are laying off staff is because the business outlook for their goods and services is deteriorating. And so if the company is going to do less business, it needs less workers. But ultimately, the fact that it's doing less business means there's going to be lower profits. But it also means that the growth rate of those profits is coming down. And a lot of these tech stocks, of course, trade at high multiples. And those multiples are a function of two things: interest rates and growth rate. The lower the interest rate, the higher the stock price. The higher the growth rate, the higher the stock price. But we have two things happening. We have interest rates going up and growth rates coming down. That's a double whammy on valuations. And so after this sucker's rally ends in these tech stocks, look for the sector to make new lows. In the meantime, the laid off workers who have to replace the job they lost are most likely going to take a job that pays less than the one they had, because these tech companies were among the highest paying jobs out there. And so workers are losing good full-time jobs, benefits, high salary. And when they go into this weak labor market, they're likely to have to settle for one, two, or three lower paying, maybe full, maybe multiple part-time jobs without benefits to take their place. And they're going to end up with lower overall earnings, but they're having to spend more time to generate those earnings. And all of this is ultimately another negative for an already weak economy. If saving more and spending less is one of your top goals for 2023, then why are you still paying insane amounts of money every month for your phone bill? Switching to Mint Mobile is the easiest way to save this year. As the first company to sell premium wireless service online only, Mint Mobile lets you order from home and save a ton, with phone plans starting at just $15 a month. In fact, when it came time to get a cell phone for my 9-year-old, Mint Mobile was the best way to go. For anyone looking for extra savings this year, Mint Mobile offers premium wireless for just $15 a month. By going online only and eliminating the traditional costs of retail, Mint Mobile passes significant savings directly to you. All plans come with unlimited talk and text, plus high-speed data delivered on the nation's largest 5G network. You can use your own phone with any Mint Mobile plan and switch easily in minutes with eSIM. So switch to Mint Mobile and get premium wireless service starting at just $15 a month. To get your new wireless plan for just $15 a month and to get the plan shipped to your door for free, go to mintmobile.com/gold. That's mintmobile.com/gold. Cut your wireless bill to just $15 a month at mintmobile.com/gold. In fact, during the week, we got a lot more economic data that supports my thesis that the economy is in fact weak and getting weaker. Earlier in the week, we got the Empire State Manufacturing Index number for January, and the consensus was for minus 8.1, and that would have been a slight improvement over the minus 11.2 that the index measured in December. The range of estimates went from a high of minus 3.1 to a low of minus 11. The actual number came out at minus 32.9. Now, that is the weakest number we've had since May of 2020. And of course, in May of 2020, we were under full COVID lockdown. So you have to go back to that time period to find an Empire State Manufacturing number that low. In fact, this is the 5th worst reading in the history of that survey. If that wasn't bad enough, The following day, we got the retail sales numbers for December, and there was supposed to be a drop of 0.8, and that would have followed what was originally reported as a drop of 0.6 in November. Well, the November decline was ratcheted up to down 1%, and the December decline ended up at minus 1.1%. So a bigger decline than people thought, and a downward revision to what was already a decline in the prior month. And in fact, if you X out vehicles, the prior month's drop of 0.2% was revised to a larger drop of 0.6%, and what was expected to be a 0.5% drop in December ended up being a 1.1% drop, and that was way worse than the upper range of the consensus, which went from a gain of 0.4 to a loss of 0.8. And then if you take out vehicles and gasoline, the same thing. The prior month's minus 0.2% was revised to a minus 0.5%. And while they were expecting minus 0.1% for December, we actually got minus 0.7%. Again, well above the worst case scenario contemplated by the consensus, which ranged from a plus 0.5 to a minus 0.2. And remember, none of these numbers are adjusted for inflation. So despite the fact that everything we're buying costs more, we're still spending less. And so that means real sales are plunging because people are buying a lot less. They're just paying a lot more for what they're buying. But even with the higher prices, overall sales are still declining. Also on the same day, we got the release of the December industrial production numbers, and once again, much worse than had been expected and more downward revisions to previous months. So the industrial production number for November was originally reported as minus 0.2. That got revised to minus 0.6. It was supposed to come out as minus 0.1 for December. Instead, it came out at minus 0.7. Manufacturing output also weaker than forecast. The minus 0.6 from November was revised to minus 1.1, and instead of getting a minus 0.2, we got a minus 1.3. That blew away the consensus, and again, way worse than the range of forecasts, which went from a high of minus 0.1 to a low of minus 0.5.